day all. Ira Epstein of Linn and Associates with your SPDR ETF video, and this is for Wednesday, the 11th of March 2020, the day we're entering bear market territory in the Dow and very close in a number of the other indices. You know, it's the COVID-19, and as we keep hearing things, it gets worse, and we expected that. At least I did, and I've been talking about it. Now the NCAA tournament, the March Madness, fans are not going to be allowed in. You'll be able to watch it on TV, but you're certainly not going to be able to go to the games. The Golden State Warriors, same thing, no fans. Now they're going into lockdown until this virus passes. The president tonight at 7 p.m. is going to be talking to the nation. Now I'm talking, I believe it's Central Time that he's going to do that. And we'll find out just what the game plan is. I don't know that the Fed can do anything. The Fed's job is not to fight viruses. It's to soothe the economy. And they can throw everything they want at it. We need to get past the hump. And what do I mean by the hump? One of the things in a hump is this. Viruses have a beginning, they go up, things get worse. Even our influenza, you peak out. We always hear that. The flu season has peaked, COVID-19. You come down the other side. Think of China in January. You came up, you had your bad cases. Now we're hearing how things are getting back to normal. Italy's probably up in this area where it's closer to a peak than maybe it is peaking, don't know. But the U.S. is coming up the ladder, and we're going to see lots of cases coming at us, and you have to be ready for that. And it's headline news, but does it mean that it lasts forever? No. Will the economy take a blow off of it? Yes. Do we have the tools down the road that we'll forget about this soon? Yeah. But you got to get through it, and you don't want to panic during it, but you want to keep your wits about you. If you look behind me, it's a sea of red. I didn't expect much different when we get to the point where the World Health Organization declares this pandemic, which they did today. The yen was the higher market. Otherwise, behind me, a sea of red. So I'm going to put on my glasses, I need them right now, and look at the market because it's like, whoa. You can see how we've been coming down on XLK, the technologies. You can see that the market's got a pattern of lower highs, lower lows, bearish. What would negate this pattern? Well, you'd have to get over 87.65. Okay, so at least we have a number in mind. Where's the market in relation to key moving averages? It's playing at the 200-day, which is under the 100, and the 18-day average is running at the market. Now, I use the 18-day average of closes to determine bias. When the market is under it, I have a filter in my other studies that says you should have a bearish bias. So if I were to get, for example, a short-term signal that said, you should get long, or you have a bullish bias off of one thing, but it's under that number, it filters out those, and they conflict, and you get no signal. That's one of the ways I use it. Bollinger Bands. Do you see this black dashed line there and here? One of the things that I study with that is how often does the market stay in the black lines? What if I tell you 95%? Go read on Wikipedia, anything that you want, Investopedia. It'll explain the theory as to how the algorithm works, which tells me each time it hits the band, I think pros build that into be it their algorithms, their trading philosophy, and they'll step out of the markets. Obviously, a lot of pros, and you hear it all the time on financial TV, are looking at 200-day moving averages for potential support. But in bear markets, you get under those and you can stay under them. Then I look at momentum on a daily basis, and momentum is down. So in summation, I have a downtrend that's attacked the 200-day, one of the last bastions of moving average support. The lower Bollinger Band, even if you take that out, that theory stays right in place, and the market is oversold. When I come to the semiconductor index, the SMH, lower highs, lower lows, bearish. The market's fighting at the 200-day average, very similar to what we just saw here with the technology sector. The lower Bollinger Band coming into play, and you're oversold in the market. When we come to the industrial sector, a downtrend, but here's possibly a difference. We have both numbers that make up the slow stochastic today under 20. They were under 20 yesterday. What about the day before? Under 20. Whenever I get 3 days in a row Until the red line pops back over 20, the momentum, I say, is locked in. It's called embedded. And the pros, I think, will sell the market until that red line pops back and stays over 20. In the energy sector, well, we know it's been a washout. How low is low? Don't know, but I've got the embedded reading. I have a market that is playing at the lower Bollinger Band. It gets under it, tries to get over it, and that's very typical. But the trend is down, the bias is down, and the market's locked in with bearish momentum. In the QQQ, the market's been fighting now for the better part of this whole week at the 200-day average. Back and forth action as it's playing there. If it gives ground, the lower Bollinger Band again becomes the support, just like it did there, and you're oversold. Trend down, bias down, target 189.84. As we come into the EFA, the emerging market ETFs, well, how would you expect them to stay up as everything? If we're getting weak, what are they doing? But there will be a time where markets run their course to the downside. We're not there. We're in a bear trend that, if you'll notice, gets under that band, moves to the right-hand side, stays there with a pattern that's been in place of lower highs, lower lows. We also had a bearish crossover right back here that I pointed out to you. Not here. Here you still got the 18-day average over the 200, and now the market gets under. That's built in. A lot of algorithms use moving average theory. Doesn't mean it's one of the only things. That's why they're an algorithm, but that often accompanies a market trying to push itself down. That's been in play as well. In GLD, when everything around you gets hurt, people tend to liquidate everything around them. Unfortunately, a lot of people liquidate things that were good for them to hold on to things that weren't so good for them. I've seen this. I've been a broker, like I say, a long time, over 50 years, and that's what happens. Or you panic and markets come out. GLD is no longer in an uptrend. It's that simple. This market stepped out of the uptrend when you took out this low right here yesterday, and now the market's just following through, and notice it went to the 18-day average of closes. Now the problem is in the market that if you close under 153.50 and you closed at 153.93 today, you held that, but that'll put the bias down. You've already got the trend down. Because you had an outside day down, you took out yesterday's high and low and closed lower, a number that could be a trap for those that are getting bearish here is taking out today's high. That could set the market back into an area where you catch these people wrong and you try to pop up. Till it occurs, it hasn't occurred. Momentum is down, trend is down, the bias is still up, but very fleeting. Now we get over to the GDX. And if you'll recall, I pointed out the same thing yesterday. You take out that low, you're out of the trend. Now you've got a higher high, lower low. You're in no man's land. Where does the market go? The bias is down. The market is trying to hold on to the 100-day average of closes. If it gives ground, be careful. Then the lower Bollinger Band comes in play. And today, that's pretty much what the market's trying to do here. As you can see, the market just let go to the downside, taking out those traders. This all ended when you took out 28.28 on the downside. TLT. I use momentum in what I think is an interesting fashion. When you have both numbers of the slow stochastic embedded, and I'm not going to repeat what that is because I do it in so many other tapes, but when the red line closes back under 80, it is a sign that price and the 18-day average are likely to make a run at each other, or the closest of a moving average under the market. I say the 18 because it's over the 100 and over the 200. But momentum has been lost. The only time you can get it back is literally the next day right away. If it doesn't do it, even by late in the day, it's generally not going to happen. And if that happens, it's a warning sign. So I think pros step out and they wait to see what's going to happen. And as you can see, it's making that run towards it. In FXE, you also lost the embedded reading today. So here you were yesterday. You had the embedded reading. Now you have a number at 76.80. I think a lot of pros by day's end we're saying bye-bye. I'll take another look at this market. If it re-embeds, they can step back in. Nobody's saying you can't come back to the marketplace. So you put it all together. You're trying to come up with game plans, and this will come up behind me in a moment. And that's what we try to do here. But here I can't tell you buy here, sell there. If you go to our website and you go under the word free offers, you're going to be able to get access to what? To my SPDR ETF video that I typically have posted around 4 o'clock on our website. That is where I can say, I want you to buy here, I want you to sell there, I want you to do nothing. I'm very specific. This is a general, if you will, intro to that. How do you get there? Go to www.iraepstein.com, free offers, bottom right. You'll see it right there. Click up for it. We'll get you the user ID and password, and away you go. I'm Ira. Have a good day.